A broad rally is lifting major indices into the record territory. All three, S&P 500, Nasdaq, and small caps hit all-time highs. Some of the sectors that are of note: technology, semiconductors, biotech, real estate, and transportations are leading the stock market higher, which is very good news. I'll explain why. The dollar is yet again at a make-or-break support level, and if it breaks below it, gold and silver could really rally pretty hard. And we'll finish up with crude oil, which is again toying with a bear market now. So it looks like we're seeing a reversal altogether. All this and more in today's edition of MasterChartsTrading.com. Market recap for Friday, April 17, 2026. As always, please hit the like button, share this video, make a comment. Even if you put thumbs up in the comment section, it helps the algorithm of YouTube present this to more subscribers. So please continue doing it, and I've been getting quite a bit of comments, so please continue doing them. Thank you very much for those comments. If you're a subscriber, stay tuned. We'll be covering quite a bit of various securities. Market breadth again is moving back into the members only category. Some of the ETFs, large cap stocks, as well as some of the speculative securities. For example, Hertz is now coming up on a breakout. So stay tuned if you're a subscriber. Throughout the presentation, I'll be using my proprietary MasterChartsTrading.com price action indicators, which are available for TradingView. This interface is called TradingView.com. It's a free TradingView.com interface. Sign up on TradingView.com, come back to my site, Master Charts Trading, sign up for one of the products, and I will open the door for you on TradingView.com. We are currently looking at S&P 500, which has indeed broken to new all-time highs. Interesting action. So notice again my indicators here, there's green, blue, red, and yellow lines. They're not based on moving average. So for example, here's a moving average. You can see it looks completely different. We can make it, I don't know, 200-day moving average. We can make it exponential, it doesn't matter. My indicators are based on price itself. They're not based on the moving average, so that's why we don't really worry about it. So notice again this gap between 7th and 8th of April. Right there, we gapped above the green line and continued higher. So now we have a gap here that is unfilled, but then again we have a bunch of gaps that are unfilled from over a year ago. So one of those days, maybe many years in the future, it might get filled, but not necessarily immediately. So right now we have a gap up. So this is good news in the sense of the price was, there was pressure for the buyers. Buyers were pressed into action, and they pushed the prices higher into first a gap and then towards the records and then into the record territory, which we closed at today. So by and large, very good action. I guess the world has breathed a collective sigh of relief after the peace or truce was declared. Hopefully it holds. I have no problem with that. Confirmation of a bull market for S&P 500, I think, should be looked at from high-yield bonds. So high-yield bonds actually did the same thing. They also gapped between 7th and 8th of April, but in this case, for high-yield bonds, they actually gapped two records. Why do I care about high-yield bonds? So high-yield bonds, this is JNK, high-yield bonds. You can see that the correlation between the high-yield bonds and the S&P 500, which is the correlation coefficient, is the thing down below here, this yellow graph, and you can see that it spends most of its time in the positive territory. So as I keep saying, when high-yield bonds and stocks move together in lockstep, that means that that's a good sign, in my opinion. Because correlation normally speaking is positive, and we want it to continue. So in this case, high yield bonds actually hit records before, S&P 500 did. And I was saying that in the previous few videos that once high yield bonds hit records, it was only a matter of time before S&P 500 and other indices hit records. So we're seeing high yield bonds hit records. Perfect. I love it. Good news, because S&P 500 correlates highly with the stocks. Some of the sectors that I am monitoring is, for example, here is real estate. This is IYR, real estate. So real estate also hit an all-time high. It's not a big sector of S&P 500, but it is a sector nevertheless. So any part of the S&P 500 hitting records, that's a good news. So real estate hit records. Technology, XLK, so things like Microsoft, Apple, Nvidia, Broadcom, Adobe, Cisco, Salesforce are all in this ETF, and looks like we are again hitting records. So this is an offensive sector. In other words, it's a higher beta, higher volatility stocks are in here. And when higher volatility stocks are hitting records, that's, in my book, it's a good news, because it is showing appetite for risk. If defensive stocks were hitting records, then we would be worried. But in this case, it's actually offensive stocks that are hitting records. Semiconductors also broke out to records, actually before S&P 500 did here. So semiconductors are part of the technology group, and yes, they are extremely volatile, and they should be viewed as an offensive sector once again. So semiconductors hitting records, very good news as well. Biotech, same thing. Biotech is an offensive sector. People don't buy biotech stocks when they think the market is about to collapse. Especially they don't push the prices into the fresh record territory. So biotech hitting records, semiconductors, technology, all of this are very good news for the stock market, since they are offensive sectors. Finally, IYT, transportation sector, also hit an all-time high, IYT. Now, if you subscribe to Dow theory of stocks, which states that if the Dow Jones Industrial Average hits records, then transportation sector also should hit records, or at least be close to records. So this indeed has happened. Transportation actually hit records before the Dow Jones did, so we're waiting for Dow Jones to catch up, and I think it will, because S&P just hit records, Nasdaq just hit records, and even Russell 2000 hit records, so it makes perfect sense. And here is Nasdaq. Nasdaq once again at all-time highs. I actually still have, half of my position that I bought back in May of 2025. I'm still holding half my position. My stop is currently at this blue support resistance line, which you can find out more by going to my website. But notice that the blue line is now trailing even higher, so I'm moving my stop higher and higher as the price action continues higher. That's Nasdaq. And then finally, small caps. Small caps is as economically sensitive as it gets, and I think small caps hitting records, well, that just shows that economy, markets, stock market, pretty much everything seems to be doing just fine. Never mind the nightmare scenario we almost got ourselves into, but seems like we're moving away from that nightmare scenario. Thank God. All right, so those are the stocks, and I think that pretty much, the fact that we're breaking two records shows that whatever was just happening most likely has been resolved. We can also look at some of the other parameters and markets that I look at, and here is US dollar. So US dollar had a pretty difficult situation. So I'm going to zoom in on this latest action first. Okay, so notice that right there where I'm hovering on on March 30th, there was a breakout above this blue support resistance line. So when that happens, that means that we're now in a bull market. Okay, when the security closes above the blue line, that means now we're in a bull market. But notice that happened is we came up above the blue line, kind of traded a little bit above it, and then broke below it. And now we're actually very close to an outright bear market. And you can kind of see that for the past 4 sessions, we've been kind of trading right around this red line. We've pierced it 3 times, but so far have not closed below it. So very, very precarious situation. If the dollar closes below this red support resistance line, it would be considered to be in a downtrend. And by extension, I would need to think about buying gold and silver. And up until very recently, I was just very ambivalent to trade gold and silver because dollar was in an uptrend. And why do I care? So let me show you. So gold is traded in US dollars. So gold divided by US dollar. If the dollar part of this equation getting smaller, then gold should move higher. So the bottom part just got smaller and potentially might be getting even more smaller because it looks like it might be in a downtrend now. And then gold miners and silver should benefit. And basically the only thing I'm waiting for right now is a close below this level. Excuse me, for a dollar currency index. And this level is 97.96, or you can just make it 98. So if we close below 98 or 97.96, you can see this red line I'm reading right off the chart, then dollar will become bearish. It will be in a bear market, and by extension we should be buying gold and gold miners and silver. So basically very, very close to this setup. We're waiting for which way the break will come, and then we will make a decision. But for now, I'm still waiting for to see which way dollar will break. Here's silver. Silver is absolutely more volatile than gold, but you know, if dollar appreciates, then or rather, if dollar continues lower, then silver also will move higher, just like gold will. Notice that silver actually tried to get down into the bear market right there on 23rd of March, but failed and bounced off of it. So right now we're kind of approaching the blue support resistance line. If we break above it, then most likely we need to be buying because new records are around the corner. Finally, I wanted to show oil. Here's crude oil. Up until very recently, there was no ifs or buts about it. We should have been buying oil. But right there on this day, on the 8th of April, I looked at this giant red candle and I was just not sure that we're going to continue higher. I was fairly certain that we're going to continue lower, at the very least retest this red line. In fact, I put in this downward facing dotted arrow, with I was fairly certain that we're going to continue lower. We did indeed do that today. We actually retested the red support resistance line, and if we don't hold here, if we break again below this level, which is currently 79.17, if we close below that level, then most likely the bullish premise for oil is just completely gone, and we will make lower lows and lower highs as we were just recently. Can this happen? Absolutely. We just need to not have war in the Middle East and potentially no supply disruptions. Alright, we're coming close to the end. Thank you for watching all the way until the end. Head over to MasterChartsTrading.com, click on sign up for one of the products. So again, I have two products, trading indicators and newsletters. So trading indicators, you can see them on this chart, this green, blue, red and yellow lines. They're available for this interface, tradingview.com. Once you sign up for a free tradingview.com account, come back to my site, Master Charts Trading, and sign up for one of the indicator plans. I have the yearly plans and I have the monthly plans. So sign up for one of those, and once you do, send me a message. I will open the door for you on tradingview.com. It all happens very quickly, within 24 hours, so you still have 7-day free trial to try it out. The newsletter, I send out daily alerts and weekly members-only videos. So for example, this week we'll be covering various ETFs, large cap stocks and speculative securities. In the members-only video, there will also be market breadth coverage. So sometimes it's quite useful. And the best deal is to get both trading indicators and newsletters. The best deal out of the monthly versus the yearly, of course, is to get the yearly subscription, and then you will get 2 months off compared to the monthly price. That's it for this week's recap. Thank you for watching and have another great trading week. Bye-bye.